Hi there, and welcome back to Money Managers, a User's Guide. I'm Nathan Peters. With all the toppiness about inequity markets here in 2021 and widespread acknowledgement of the worst ever environment for value investing, I thought it'd be useful and hopefully educational if we cast our eyes and some of our modern tools back to an era before passive indexing took over the world, the late 1990s, early 2000s. Yes, this period, of course, covers the internet bubble, but that's not what we're going to focus on this week. This week, I'd like to focus on the incredible, statistically almost impossible feat of 15 years of consecutive outperformance of the S&P 500 by the first legend I was aware of in the active management business, Bill Miller. When you look around at the smaller group of high-profile active managers that remain these days, it is rare to find anyone outperforming a cap-weighted market over any reasonable stretch of time, let alone for 15 years, as Bill Miller did from 1991 to 2005. But the fact that he did it, overcoming all the vicissitudes of time, overcoming the landmark market reform of 2000, regulation fair disclosure, and still generating excess returns is remarkable. So let's take a look at the record through Venn, shall we? Bill Miller left the fund that he made famous in 2011, but his track record lives on through the ClearBridge Value Trust, ticker LMNVX. I only have the daily data back to 1995, but that will have to do for our purposes, and 10 years of outperformance gives us plenty to dive into. So what do we see other than the astounding feat of outperformance at 7% per year for 10 years, taking about 9% tracking error versus the benchmark? On an absolute basis, if you bought Bill Miller over the period, you'd be up almost 2.5 times on the index. You'd have trounced the bogleheads, even after exorbitant fees. If we look to our factor lens, you can see that 82% of the tracking error comes from pure stock picking. And we see that relative to the benchmark, we see no statistically significant stylistic or other factor biases, other than that Bill Miller took a little more equity risk than the market, liked more volatile stocks on average than the market, and preferred lower quality stocks on average than the market. But of those biases, only equity risk contributed to return, and only by about 73 basis points on average. So really, all the return, all the genius, all of the best track record ever came from the strength of Bill Miller's decisions in selecting a small subset of stocks and having those stocks beat the average of all the rest. Now, over 1 year rolling windows, some of the humanity, some of the imperfection starts to come out. Bill Miller did underperform, sometimes significantly, over a 12-month stretch. But Bill's adoring public only cared about the calendar year-end streak. It got very dicey in the recession of 2001, 2002, but Bill first made money tilting towards value in 2001. Sound like 2021, potentially? Ending up positive. But then when his low-quality stocks got hammered in 2002, stock picking saved the day, and Bill printed yet another solid outperformance in 2002, and on it continued for another 3 years. Brilliant, right? So what happened? Roll the clock forward, and that Herculean show of prowess deflates in symmetrical fashion over the next 5 years he ran the fund, leaving the great Bill Miller pushing a rather more pedestrian 0.2 information ratio before handing over the reins. It's tempting to chalk up the losses incurred in the great financial crisis of 2008 to Bill's penchant for low-quality, risky stocks.
In the entire history of Wall Street, no investment bank has ever failed unless caught in criminal activities. So, yes, I stand by my Bear Stearns optimism.
But statistically, those factors hardly detracted from the negative 27% pasting versus the benchmark, which was itself down negative 37%. It was all those individual stocks that were the culprit. Making bold calls used to make money, but in 2008, Bill Miller's decisions were lighting investors' capital on fire, and he never recovered. What are you going to do when faced with this sort of epic about turn? Anything humans create is transient and not long for this world, even and perhaps especially when it appears to be rock solid, a sure thing. I think we would all do well to internalize this lesson, especially when it comes to active management. In my career, I've been privileged to meet with all manner of investing superstars. Some more humble than others, but essentially all have lost their touch at one time or another, and you're faced with a difficult choice: cut and run or stick with it. I wish I could say that a pattern emerges over time and that there is a playbook, but unfortunately that's not the case. There is no right-wrong, only more or less successful outcomes. My colleagues and I have formulated a process that we think works well, that investigates each manager's proposed competitive advantage in detail and tracks outcomes versus expectations. But this is what full-time professionals do. If you, dear viewer, seek to align yourself with investing talent, measure what you can. Watch this and other channels that share hard-earned insights on how to get value for money. And above all, avoid doing the easy thing, like picking Bill Miller in 2005. It usually ends up being a raw deal. In short, thanks for making it this far with me on Money Managers, A User's Guide. If you found this content helpful, please like, comment, subscribe, and hit the bell for notifications of future episodes. And remember, use your money manager. Don't let them use you. Thanks.